When Vijay Shekhar Sharma started Paytm, a little over a decade back, he had everything going for him. A modest background, a brilliant idea, and an insatiable hunger to disrupt. Along the way, familiar men like Jack Ma and Warren Buffett hitched their wagon to the company. Sharma became a star. And then a lightning strikes. India's largest IPO, Paytm's thus far, has tanked despite the best efforts from management, its heavyweight bankers, and popular institutional investors who lent their support as anchor investors. But when $5 billion was shaved off Paytm's $20 billion valuation, the stock market has once again proven why it is the best leveler. But why did Paytm bomb when Zomato or Nykaa, its unicorn peers, both went bumper? They both are market leaders in their own space. Nykaa is also profitable, even though its net profit plummeted 96% in the September quarter right after its dream debut. And there is always a layer of regulatory risks and uncertainty. Paytm prospectus reads, "We expect to continue to incur losses for the foreseeable future, and we may not achieve or maintain profitability in the future. We cannot assure you that we will ever achieve or sustain profitability, and may continue to incur significant losses going forward." The crux of the problem is the business model itself. On the back of the initial success around his core offering of digital wallets, Sharma went on to try and create a financial supermarket through strategic alliances with online travel and e-commerce. He got a massive leg up in November 2016, when Prime Minister Modi announced demonetization. Sharma's fledgling app, whose name is shorthand for Pay Through Mobile, became an overnight sensation. A verb synonymous with payments. Much like his guru, Jack Ma, Sharma too wanted to sell insurance, offer loans, asset management, broking, movie tickets, and even sell shampoo and mobile phones. But by spreading the company so thin, so fast, most verticals haven't gathered scale or profit, whittling the early advantage. Today, Paytm lacks competitive advantage for users or merchants to download the app. It just has too many fingers in too many pies. Functioning in multiple business lines inhibits Paytm from being a market leader in any business except wallets, which are becoming inconsequential with the meteoric rise in UPI payments. Competition and regulation will drive down unit economics and growth prospects in the medium term. India has no walled garden like China. China's thrived on being a duopoly, and that made it mint money. Paytm is still bleeding after 10 years. The Paytm surge ended when UPI killed all digital wallets, with its neutral railroad that opened our payments landscape with real-time transfers for both person-to-person and person-to-merchant. The added features further accelerated growth but also made the space overcrowded, with deep-pocket big tech companies like Google, Facebook, Reliance and Walmart jumping right into the pool. Today, Google Pay and PhonePe are the dominant forces, cornering 40% of the market, forcing Paytm into third place. Finally, with QR codes becoming interoperable, Paytm's presence at the merchants will also diminish drastically. The battle in the payments app space now rests upon who offers the best user experience with seamless, feature-rich platforms. But it also translates to a fragmented market, with no customer loyalty, and depends on freebies and cashbacks. Further, with zero MDR, wallets on a standalone basis are unlikely to make money, thereby forcing them to use payments to hook users and then offer a portfolio of services like insurance, wealth management, lending to monetize them. In pre-listing, the signs were ominous and valuations stretched. Months before the listing, key Paytm officials, including Amit Nair, brought in to change Paytm into a full-service digital financial services powerhouse. Amit resigned later. Hedge funds became the company's top 5 investors when the anchor book filled up. Domestic mutual fund managers were miffed by the high-handedness of the management in sharing data or giving access. The quality of the Paytm book was the trailer of the show that premiered on day one when it listed. In a hyper-competitive market like India, Paytm has increasingly looked shriveled, losing share, sheen, and its core payments business. Take away the discounts, and most of its businesses disintegrated into pieces. Unless Paytm gets access to lending, or has a shadow bank in its fold, scaling up will not be easy. The banking regulator has been sitting on its NBFC application for the last 2.5 years. Even its request to become a small finance bank from the current payments bank setup is being held up. After facing the regulatory RBI's rap in 2019 for audit lapses. And the competitive landscape is changing dramatically fast. Is it the end of Paytm? No. It needs to hunker down and regroup. Paytm has to lend, using its own balance sheet to make loans, and to do that it needs a banking license, credit underwriting experience and collection infrastructure, all of which are lacking at present. Subscribe to our channel to get new video updates. Thanks for your time and thanks for watching.